Let's have a look at leases. But before we carry on, let's consider the type of lease and what effect it has on the lessee or the lessor. In the case of an operating lease or a finance lease, the lessee is not the owner. Therefore, they will not be entitled to claim any capital allowances. However, they will be entitled to claim their lease payments as a deduction, provided obviously they are incurring it in the production of income or for purposes of a trade. So an operating and a finance lease is seen more as a rental agreement for income tax purposes. When we have a look at an installment sales agreement or an installment credit agreement, now we are the owner as the lessee. Therefore, we will be entitled to claim capital allowances if we meet their criteria. We will not get the payments as a deduction. We will have the capital allowance. The interest on that installment sales agreement will be a deductible expense in terms of Section 24J. So that's for the lessee. What about the lessor? In the case of an operating lease, the lessor is the owner. Therefore, they will be entitled to those capital allowances. Obviously, depending on what the lessee is using those assets for that are under either an operating or a finance lease. In the case of an installment sales agreement or an installment credit agreement, the lessor is not the owner and will therefore not be entitled to claim any capital allowances. Now, what about lease premiums? We will be granted, as the lessee, an allowance in terms of Section 11F. We also have leasehold improvements, and again, as the lessee, we will be entitled to an allowance in terms of Section 11G, obviously provided we meet the criteria. For the lessor, they would be required to include the lease premium and leasehold improvements in their taxable income, and therefore, especially with the leasehold improvements, because they have to now include that full effect of the leasehold improvements in their taxable income, there is a relief that is applied to the lessor. And lucky for you, we will provide you with the amount of the relief in a question. Lease premiums. The definition is consideration of the same nature as rent, passing from the lessee to the lessor over and above or in lieu of rental payments. This came out of the Butcher Brothers case. For the lessor, these lease premiums will be included in gross income under paragraph G. For the lessee, we must have incurred these lease premiums in the production of income, and it must be derived therefrom and taxable in the lessor's hands. So the lessor must be taxed on the lease premium in order for the lessee to qualify for a deduction in terms of Section 11F. When do we start deducting the premium? In the year in which the premium is paid. The premium will be deductible in annual installments, and it is over the lease period. However, that is limited to 25 years. Should there be any extensions included or potential in the contract, in the lease contract, we will add those probable extensions when we are calculating the period over which we will deduct this lease premium. The lease premium deduction is apportioned for part of the year. It's important to note that there's a difference between a lease premium and paying the lease rental in advance. The lease rental in advance, we need to look at sections 11A and 23H for prepayments. For the lease premium, we will be looking obviously at section 11F. Now with leasehold improvements, for the lessor, we would need to include the value as stipulated in the contract in their gross income in terms of paragraph H. For the lessee, he must have incurred in the production of income or income to be derived therefrom And again, it must be taxable in the lessor's hands in order for the lessee to qualify for a deduction under Section 11G. The allowable deduction relates to the obligation in terms of the agreement. So in other words, the amount that the lessor will include in their gross income will be the amount as stipulated in the contract. The amount that the lessee will be able to claim a deduction for in terms of leasehold improvements will be that stipulated amount. If the lessee goes and spends more than that, then we'll have a look at what they can do with that excess. If the lessor is not paying tax on these leasehold improvements, so in other words, if the leasehold improvements are effected on, let's say, government land, government is not a tax-paying body and therefore they would not be taxed on these leasehold improvements, then the lessee would not be entitled to a Section 11G allowance. You can have a look at Section 12N where we will discuss this further. The lessee will apply the cost as specified in the contract over the remaining lease period, again maxed out at 25 years. How do we calculate the remaining period on leasehold improvements? Well, we need to take the original period minus the period from the date of the right of use until the completion of the improvements. Okay, it's important it says completion of the improvements, not at the date that those improvements are brought into use. We will also add any period where the renewal is probable. Just like lease premiums, we will pro rata for part of the year from the date that is brought into use. Remember to include any extension periods, and the lessee may qualify for a Section 13 manufacturing buildings allowance on the excess, so where they have spent more than what was specified in the contract, then they could potentially qualify for that Section 13 allowance, because for that amount that they exceed the contract, they would then be deemed to be owner of that amount that exceeded the contract. Let's have a look at an example. If we have a factory building under lease, and on the 1st of May, we obtain the right to use this factory building. On the 1st of September, we complete the improvements, so we have 4 months into our lease contract. On the 1st of October, we bring this leasehold improvement into use, and the year of assessment ends on the 31st of December. 3 months from the time that we brought the asset into use. The contract period is 15 years. The contract price, according to the contract, was stipulated at 1.5 million for these leasehold improvements. The amount that was actually incurred by the lessee was 2 million. What period was the contract for? Well, 180 months. Now if we're going to have a look at how to calculate the allowance that can be claimed in this year 1, well, we're going to have the 1.5 million and we're going to divide it, remember, by the remaining period, being the difference between the time that we obtained the right to use this asset under the lease agreement and the time that once the leasehold improvements were completed. So that was 4 months. We will then multiply that by the 3 months in order to get our leasehold improvement deduction. The reason our calculation only multiplies it by 3 is because we used months when we were dividing the 1.5 million. Had we used 15 years minus 4 months, we would have then applied the 3/12. If the period had been 26 years in the example, then the remaining period would have been limited to 25 years, because remember, we are always limited to 25 years when we are calculating the allowance in terms of Section 11G. Now what you can see is we used the contract amount in order to calculate the 11G leasehold improvement deduction. However, we actually went and spent an extra 500,000. We spent 2 million. We will be entitled as the lessee to claim an allowance in terms of Section 13 on that excess. So that 500,000 we will be able to claim the 5% as a Section 13 deduction. When we look at deductions with regards to improvements that are not owned by the taxpayer, however, Section 12N applies. So this would be the case where we effect leasehold improvement on, let's say, the municipality or government-owned land where the taxpayer, the lessor, is not liable for tax. In this case, the lessee will effect and complete the improvements on the leased property. It must be used in the production of income, or income is derived therefrom. The lessor would be government or certain tax-exempt entities, and in this case, Section 12N will deem the lessee to be the owner of the improvements. So in this case, we cannot get a deduction in terms of Section 11G because the lessor would not include the leasehold improvements in their taxable income because they are tax exempt. Therefore, Section 12N will kick in, deeming the lessee to be the owner of those improvements, and therefore if Section 12N is applicable, we can claim Sections 12C, 13, 13 Quin, and 13 Sex, which are not otherwise available to the lessee. They will now become available as we are seen as the owner of those improvements, and therefore we will be able to get the deductions.